Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. So welcome, Diego. I've been looking forward to our podcast for a while.
Likewise, it's been a few years since we worked together back in London at JP, so great to catch up again. Thank you.
Absolutely. Well, talking about working in London back in the day, I always do like to ask guests something about their origin stories. You know, where did you study? Was it inevitable you would end up in finance? And what's been your journey from university to where you are now?
Well, I am a mining and petroleum engineer, originally from Spain. I got a scholarship which allowed me to do my master's in mineral economics. It was a joint degree between the Institut Français du Pétrole, the French Institute of Petroleum in Paris, and the Colorado School of Mines in Golden in the US. And I did my thesis in something called real options, which effectively was using options theory to value real assets. One of my professors would talk about, a lettuce being a call option on a salad, and that sort of influenced my view of the world, and somehow it gave me the opportunity to join investment banking in a trading job at JP Morgan in London in the mid-late 90s when we met. That was a time when commodity markets were collapsing, a number of banks were shutting down. JP Morgan kept the precious metals division, but they shut pretty much everything else. And we were integrated into the FX desk. So I started out trading FX and precious metals. I did it for a while. Then I had the opportunity to join Goldman Sachs, the JR division. And I did that for a while, which is amazing. And I had the opportunity then to move on to Merrill Lynch, which was one of the newcomers at the time, looking to build up the commodities. And together with a team which I led, I moved to Merrill, and that was a fantastic journey between those years between London, New York, and then Singapore. First movers into a lot of things like risk premia and a lot of fun. And eventually, I had the opportunity to move on to the buy side, which I did with my own firm, and I've worked also with some large macro players such as BlueCrest, Dymon Asia, and Old Mutual, before I eventually moved back to Spain, where I'm the managing partner for Quadriga Asset Managers, which is a 1.8 billion manager, where I run basically a global macro and volatility and tail risk fund. And in addition to my experience on the buy and sell side, I'm also a best-selling author. I wrote 2 books, one bestseller called The Energy World is Flat, together with my good friend Daniel Lacalle, which was published in English and Spanish and Chinese. And a second book called The Anti-Bubbles, or Anti-Bubbles, potato, where I coined the concept. Both books have in common that they're very contrarian theses, at least at the point of publishing. And I think those theses have been arguably reinforced with the passage of time. So my journey into finance was a bit of luck. Honestly, I was very much earmarked to go into engineering. My father was an engineer, and that was my view. But the masters really opened a new dimension, and at that time I was blessed with that opportunity, and I've spent my life in financial engineering, where I actually think a lot of my skills and that I learned through engineering have proven to be very, very helpful, even if I'm an outsider from the macro economic side. I think you get to come with a very fresh and biased perspective, which allowed me to challenge a number of things. And
absolutely. And I think the world we're in at the moment as well, it seems like commodities seem to be driving everything as well. So I think having a good sense of kind of the practical or the real aspect of the economy, I think is very, very important. So you have a really diverse background, which is great. And your books have been excellent as well. And I'd recommend people to read them. Before we go on to talk about some of the themes that you've been talking about more recently, anti-bubbles, what do you mean by that? What's the definition of an anti-bubble? Because that's quite a original concept that you coined.
Yeah, I mean, I think I like to start with the concept of a bubble, and I always borrow George Soros' definition of a bubble, which effectively he's talking about assets that are artificially expensive based on a belief that happens to be a misconception. So bubbles are artificial setups where effectively the emperor had no clothes. The idea, what I did a bit as an engineer, is I generalized the framework. And I said, well, misconceptions can distort reality, but not only through artificially high valuations, we could also have artificially low valuations. So the first idea, the first concept, the first dimension of the anti-bubble, I'm referring to assets that are grossly artificially cheap based on a misconception. So it's a matter of when, not if, that those valuations will normalize higher. The second dimension of the concept comes from the fact that bubbles and anti-bubbles are like distorted mirror images of each other. They're effectively two reflections of the same misconception. So by construction, the moment the misconception is understood and the bubble bursts is the exact same moment that the anti-bubble will reflect. So in terms of timing and catalyst, it's in some ways a very good hedge. And I called it anti-bubble a bit like an antivirus or an anti-missile. It's a defense mechanism against the bubble. And the third dimension comes from the idea of risk premia, being contrarian. And very often, if you think about a bubble anti-bubble relationship, for me, for example, is the S&P and the VIX. Okay, you have a situation where artificially low volatility can contribute to artificially high equity prices, and in fact, it could well be the collapse in equities that triggers vol to go up, or it could be the moving vol up that triggers the equity down. Either way, we're talking about reflexive relationships that feed on each other and that create this concept. So behind this idea of anti-bubble, there's a lot of dimensions, including, I guess, what I tried to do in my book, which was, okay, what are the current beliefs that are, in my view, misconceptions? What are the bubbles? What are the anti-bubbles? And how do we take advantage?
Okay, no, that's great. And I guess this kind of colors your recent thinking in your writings as well, this framework. And one thing you've talked about in your recent notes is this idea of monetary and fiscal policies without limits. So what do you mean by that?
Well, what I mean by that is that with central banks and governments are in a situation where they, every time they're faced with a problem, they tend to resort to the same answers, same tools. So we've used monetary policies without limits, meaning I can print as much as I want. I can bring interest rates as low as I want. I can even do negative nominal yields, and I can do it without any harm. I am omnipotent, and we're in control. And so generally speaking, we would have thought that monetary policy had limits. You could only print so much, you could only bring rates so low, but this idea of monetary policy without limits is just, they can do whatever they want. And once you break certain floors or ceilings, such as zero interest rates, and you go into negative nominal yields, it's kind of game over. And that's part of what we saw. The flip side of monetary policy without limits is fiscal policies without limits. Well, at zero yields or negative nominal yields, I can borrow infinite. Why not, right? You're paying me for borrowing, and I could do good use with this, theoretically. And so, in a way, they kind of feed on each other. And the fact that fiscally we've grown debt to unsustainable levels has forced central banks to reduce the interest you charge on that, and both through the actual rate and artificially by effectively doing QE and other measures that control the credit spread as well. and this creates this vicious or virtuous cycle initially that can easily become a vicious cycle as things unfold. So ultimately, this illusion, that you can actually print and borrow your way out of problems, it's actually a big misconception.
And in terms of where we are today, because obviously we've had inflation pick up, so central banks have been forced to start to raise rates. And on the fiscal side, I guess it's not clear what the limits are, because there's lots of countries haven't really tightened fiscal that much. They've it's not as aggressive as it was during the COVID years, but no one seems to be introducing austerity. So where do you think we are in terms of? I mean, do we now see limits at least to monetary policy?
Well, it's all interrelated, and I think what you see is that monetary and fiscal policies do not solve problems. They do four things. The first thing they do is they delay the problems. So we're effectively kicking the can down the road through spending and debt. The second thing you're doing is you are transferring the problems, and you know this very well: currency wars, bigger than ever, and the mirror image, which is trade wars. So you are devaluing your currency by 20%, I'll tariff you by 20% to effectively offset that. This is not solving the problems either, it's transferring them. The third thing that's happening is we're transforming them, and we're transforming it into inflation, as you point out, and its byproduct, which is inequality and other second and third order undesired effects, such as social unrest and wars, etc. And lastly, what's happening is we are enlarging the problems. And I think this monetary and fiscal policies without limits have effectively led the way to bubbles too big to fail, to systemic bubbles. And that's why, as you pointed out, right now we're in a situation where central banks are in a way trapped between inflation, which is not inflation per se, but also inflation expectations, that as they de-anchor, effectively create this vicious cycle that is extraordinarily difficult to stop and extraordinarily dangerous. On the other hand, we have bubbles too big to fail with levels of debt that are totally unsustainable, that will be challenged and exposed by these hikes. And so right now, they can only cross their fingers and say, well, let's hike and hope that things don't collapse. And yesterday, as of recording today, yesterday was interesting because the Fed is announcing, you're finding this neutral point where if we keep tightening from here, we know what happened in Q4 2018. Let's be careful. But of course, we couldn't leave things below. So have we reached limits? I think we are now at the point where further tightening will expose the fiscal imbalances, and they need to be very careful with that. And you have a situation where inflation is certainly not going to be controlled by this level of hikes, partially because they're too low, and second, because there are many parts that are just not going to be driven by monetary, including lack of investment and bottlenecks and plenty of other things. But largely, I think inflation is a monetary issue, and the damage is largely already done. And we are going through a process that overall, even with positive nominal yields, those will be substantially below inflation, not only the official inflation, which is, with all due respect, total BS, actual even real levels of inflation. And that's why I believe what I call real rates, the actual negative loss of purchase power that we experience as investors and consumers is going to be very deeply negative. So I think the central banks are, in the US, they have more room to maneuver. Europe is significantly more challenged for multiple reasons. We went way farther into negative rates. We have a bigger problem with the governments, and we have a massive issue on the energy side, where the US is ahead. And I think this effectively limits the ability for central banks to operate without really creating havoc and having to unwind everything they've done.
Yeah, and you mentioned this idea of real rates. So obviously, there's nominal rates, there's what the interest rate you see, 1, 2, 3%, whatever it may be, then normally people subtract inflation, normally measured by CPI, that becomes a real rate. But you're saying there's a real rate. So can you elaborate a bit on what you mean by that?
Well, effectively, how first of all, inflation is an amazing thing. We all talk about inflation, and very often we refer to inflation as if it was this one thing. Inflation was 1.3%. Well, your inflation basket is different to mine, is different from all the people that are listening. Some of us might have university fees, some people might have nappies, some people might have whatever. So inflation per se is not a single number. And ultimately, when we think about how do we measure inflation, whether it's consumer price or producer price, or even inflation break-evens. Inflation break-evens is fascinating because you could think, okay, fine. CPI it can be manipulated because the central banks or the governments decide what's the basket, and this is almost like you're moving the post at your convenience. So now I want to have oil, but now I don't, and now I want rent, now I want whatever. So to be honest, we all know that CPI and PPI, or to a certain extent, anything that has a hand-picked basket, that basket is unlikely to be a fair representation of your own basket, and it's almost definitely be underrepresenting your. So the fact that CPI can be at 8, 10% is scary, and for me as a proxy, I would say real inflation on average is at least twice the official inflation. Now, let's talk for a second about inflation break-evens, and then we finish, because I think it's interesting. Inflation break-evens, we obviously have a fixed income market between, nominal treasuries and inflation protected, and you can effectively create an implied inflation, which is what we call the inflation break-even. Now, this is obviously arguably a better proxy because it's not manipulated by the basket, but it's effectively the reflection of where the market is. And I think this is a good representation for what I would call institutional inflation, because ultimately, who are the buyers of tips and treasuries on the margin? And we're going to have the big institutional real money. So in that sense, if you think about LIBOR, okay, we all talk about LIBOR. Can you borrow at LIBOR? Can I borrow at LIBOR? No, that's an interbank basic borrowing rate. Now, I think what happens here is the same. Is just like people borrow at LIBOR plus 1% or LIBOR plus 5%, I think we should think about inflation as break-even plus 1% or break-even plus 5%. So you have that sort of dynamic, and I think you think about what we experience in our pockets, and it's going to be a function of where you live, where you work, what your basket is. But I think the idea is that the actual inflation, meaning the loss of purchase power that we experience, is substantially higher than official inflation and break-even inflation. And that's why I think real rates being computed with this inflation that is low is not quite a fair reflection, and why I think we need to refer to real rates, because those are the ones that are going to drive your behavior and my behavior. The reason why we may decide to take the money out and buy a house or land or gold instead of basically keeping it in fixed income or other things. And I think real rates will help explain behavior better than just plain nominal or real rates.
And so this would suggest that, because the real rate is more negative than the real rate, it would imply that we're still in the bubble inflation sort of mode. It's still the kind of broader asset inflation environment that we're in. So it suggests that central banks need to do even more to try to draw that back, but they're constrained, because they don't want the bubble to burst, I suppose.
Absolutely, and let me give you an example, an analogy that I use that I think will help explain. And I wrote this newsletter called "The Frogs in Boiling Water," and I use this analogy to explain inflation. So I would argue that we're all frogs in a monetary broth, okay? And that monetary broth has been, the temperature has been increased at an official rate of 2% per annum, okay? So Why 2%? 2% is sort of the magical number where it's low enough that us frogs will stay in, but it's high enough that within 10, 20, 30 years, you'll be boiled to death. Now, why did the frog jump? Well, the frog would jump for two reasons. Either because they feel the temperature is risen significantly, so it's no longer 2 degrees or 2%, it's 10%. So I'm like, guys, I'm out of here. Okay, I need to do something different. But second, and most worryingly, it's because the expectations that the temperature will continue to grow. And that's when the frogs start to jump. Who wouldn't jump? People who won't jump are people that are in benchmarks, that are literally handcuffed to the ball, that they can't jump because they're in it. But anybody that has the freedom to jump out in a high inflation environment, when as frogs we feel this enormous amount of pressure building over cash, fixed income, or credit. I mean, at the end of the day, it's a paradigm shift because it's no longer a nominal game where the goal is to take 100 euros or $100 or pounds and turn it into 101. If I make 101, but inflation is 10%, I lost 9. So we're now in that game where this is starting to impact investor behavior. And I think perhaps one of the best case studies is Japan and JGBs and yield curve control. So what happens there is, as you well know, Japan has been leading arguably the monetary abuse around the world with zero rates, with printing, QE, and then going into yield curve control. For those who are not familiar with what it means, you can take rates to zero. You could then decide, to give 120 billion to Jerome Powell and say, buy stuff for me. Or you could say, you have a blank check, buy whatever it takes, just make sure the JGBs are attended. And what's been happening as inflation increases and frogs say, why would I stay at 0 or 10 yields, 10 basis points when I'm being boiled to death? I'm going to jump, I'm fed up. That puts pressure on the long-term yields, right? Because you're basically exiting. And then that leaves Japan in a very dire situation because you say, okay, wait a minute. I have this ginormous amount of debt, call it 300% debt to GDP or whatever the exact number might be. If rates go up or yields go up, I have a problem. At the same time, I said I would control this, and people are exiting. And so they're exiting because of inflation. The solution to contain yields is to print more, which is inflationary. And so in a way, you create this vicious cycle, which is the reason why dollar yen went like 20% in no time, because you're effectively calling the bluff of yield curve control and this idea that you have this stability and you can print ad infinitum and there'll be no inflation. Yes, there might be inflation, which means who's going to pay for this party? Easy. People that are effectively long cash, credit, and fixed income. These are the guys, and the frogs that either voluntarily or involuntarily stay in the broth, and in my opinion, are going to pay for this. So I think inflation is stubbornly high. Real rates will remain more negative. And I think this dynamic means that ultimately, if our job is to try to predict what the frogs will do, you don't need to look at the official temperature that they're telling you the water is going. You don't need to look only at the real temperature, but also the expectations and who is jumping and why, and who isn't. But I think those things are critical because they drive these cycles. And
what about at the moment, at least in markets, people are very focused on the possibility of a recession. People are expecting recession sometime in 2023, and because of that, people are saying that maybe we've seen the peak in inflation. The growth side's the more important side of it all, so that will end up bringing inflation down, or at the very least, it will stop central banks from raising rates. They may end up starting to cut rates, which then could be positive for equities. And we have this kind of weird cycle where you have a recession, but it's good. So bad news is good news. What's your thinking around kind of the recession side of thing and how that fits into the whole equation?
Well, I think if we think back about the whole deflation debate, there's been forces in both directions, right? In fact, there's been plenty of deflationary forces in the system, whether it's demographics or productivity or overcapacity or many things, right? What has been happening is central bank printing it's like you dig that hole, and central bank printing has been filling that hole with paper. And it's ironically, the more deflation in the system, the more they could print without getting noticed, right? So effectively, inflation has always been there. The problem is when some of these things reverse and you're exposed. And so I think recession in itself, the courses, the pluses and the minuses on the inflation balance are in both directions. But ultimately, the key driver for inflation is monetary. It is true that in this case, things have been compounded by a war and bottlenecks and lack of investment, and this is a problem that is not easily resolved. It'll take a while. I think in commodities, from the moment you say go till that drop of gasoline is in your car, it can take many years, right? Same thing for a copper mine or whatever. So I think some of these issues will be difficult to resolve. A recession, strong recession, would still be bad news, of course, for demand. That can take some pressure off the commodity demand side of the story. But the other two sides, the supply in many commodities is extraordinarily dire, the outlook in terms of growth. The inventory situation is extraordinarily tight. And so you're going to need a substantial gap of supply being above demand to normalize inventories. And I think overall, the flip side of the recession is, you have companies shutting down, more unemployment, more many things that mean you're going to have to, I think, unwind some of the hikes and give some support, which effectively it's what brings us to the ultimate reason for inflation, which is money printing. So I think the unfortunate direction which we're going is lower growth and persistent inflation, which is, for me, a stagflationary environment is the most likely outcome.
So not a great environment. I mean, what does that then mean for markets then, or how would you set up your portfolio in this type of environment?
Well, I use the analogy that an investment portfolio is like a football team, okay? and the idea is, I'm Spanish, so I explain it in a way that people understand. No, but jokes apart, it's a little bit more deep than it sounds. The idea is that when you build a portfolio, you need strikers, you need midfielders, you need defenders, you need goalkeepers, right? Effectively, what do I mean by strikers? I mean people that will score goals, will make you money, and they generally do that by doing it when the world is doing well. So the world's doing well, things that are positively correlated will do well. But there are times when things turn around. Could be a crisis, it could be a shock, it could be whatever. The goalkeepers and the defenders are the assets that are going to do well when the world does badly, right? And this is not a game of having a crystal ball. You, as the coach of the team, decide, okay, how do I want to play this match? Which players am I going to put on the pitch? And how I'm going to rebalance them. And I think that the first dimension that I would highlight is that, unlike in the last few years, we lived with this central bank put, which in a way is the referee is bribed, and every time there's the other guy's team's attacking, the ref goes, offside. So why bother with a defender? Why bother with a goalkeeper if mommy and daddy, are there to defend you? So lots of people have been playing, and the portfolio is been effectively composed with 11 strikers, right? Which leads to the risk of what I call false diversification, which effectively it's confusing two things. It's a portfolio with many things and a diversified portfolio. They're two different concepts, okay? If your portfolio with many things, when March 2020 comes, every single thing falls at the same time, you were not diversified, okay? And so I think it's absolutely critical, and that in this new environment, I think the referee can no longer at will just come and support the markets per se. Obviously, they'll be forced to do that in a proper crisis. But I think this match is going to be much more two-way, much more volatile. And back to the crystal ball, I don't think the job of the coach is to say, well, I have a crystal ball, and for the next 10 minutes, the ball is only going to be there, or I only put players there. To be honest, the role of the coach is the opposite of a crystal ball. Is I have no idea where the ball is going to be. But what's going to happen is if the ball is there, I have guys. If the ball is there, I'm going to save, I'm going to pass, I'm going to score. And this is a game actually of capital preservation and compounding on capital preservation. So I think the defenders, whether it's in the investment world or the football per se, are grossly undervalued. And I personally think the most important player in a football team is the goalkeeper. So that is, I think, Real Madrid fans will know that Courtois was probably the key guy for the final. So this is something.
By the way, I'm a Liverpool fan, and so
I couldn't remember. I'm so sorry.
It's a raw nerve, that Real Madrid beat Liverpool in the Champions League final last season, and it was Liverpool had so many shots at goal, and Courtois was just amazing. Somehow he was saving everything, double saving. It was quite.
It was unbelievable. I honestly think the goalkeeper is, as I said, is very often undervalued. Is one of the most important parts of the team, and I think that applies to investment portfolios. So the first big advice I would give to investors is make sure you're not falling in the trap of false diversification. Build a team that has the proper strikers, midfielders, defenders, goalkeepers, and this helps you embrace volatility. You don't need to fight volatility. If there's a crisis and things collapse, you want to be long insurance that you can monetize and buy cheap assets. And if the market goes crazy high and is giving you free insurance, you should monetize your strikers and buy goalkeepers. And so the strategy that I manage in a way is designed as a goalkeeper, and it's been helping investors.
So what would an example of a goalkeeper be in markets?
There are many of them. In fact, you could think about, we'll come back to the second dimension of the team, which is inflation, right? But the first thing is this idea that you need the balance between strikers and defenders. And the second idea, just to complete, is not all strikers are the same, not all defenders are the same. So in a high inflationary environment, I think you should basically build your team with a long inflation bias, which means equity is better than credit, real assets better than cash, anti-bubbles better than fixed income. So Beckenbauer, the Bund, I call the German Bund Beckenbauer because once upon a time he was a great defender, but at such low yields with the euro, etc., the guy is now 75 years old. So the capacity for Beckenbauer to defend or the Bund to defend is limited, and that means portfolios that are counting on fixed income to defend have lost power. But let's go back to a typical defender. There are many of them, I think, on the anti-bubble front. As I said, fixed income historically was a defender. It's the defending role has been limited by artificial low rates. But I think volatility is a very important anti-bubble and a very important defender. Not easy to play, things like the VIX. But generally, the way we think about this, it's we buy insurance. In our case, from a risk management perspective, we only buy options. This is theoretically quite limiting because most people scratch their heads and say, how are you finding that option, and etc. But many of the biggest blow-ups I've seen in markets are always coming from hidden leverage, either by selling options or long shorts with open-ended risk. So I think you could build, there are many ways in which you could get defenders. One could be puts on risk assets. So you buy put options on the S&P, on Euro stocks, on whatever. You could also buy call options on defensive assets. So you could buy call options on the VIX, call options on gold, call options on the dollar, call options on treasuries. So the idea is, again, both of them have the potential to do well in crisis, whether it's puts on risk assets or calls on defensive assets.
One issue people have with options are they say options are expensive. So in general, implied volatility, which is used as an input to price options, tends to trade above realized volatility. So there's a vol risk premium. And so people take that as a measure to say that, okay, options are generally expensive, and so you're paying up for the optionality. What do you say to that?
Well, look, there are two fundamental ways to trade options. There are two big schools of thought. The first school is what I would call the Black-Scholes boys, and the second school is what I would call Monte Carlo boys. So how do they work? The Black-Scholes school of thought is, okay, effectively, I'm trading volatility. I am effectively non-directional. Okay, so I'm gonna buy a put option. I'm going to delta hedge it, so I have no directional risk. And as the markets move, I'm going to, through the convexity, I get some gamma. I'm gonna buy and sell the market. Effectively, I'm playing, as you mentioned, the implied versus realized. Okay, so you could have a scenario where you bought S&P puts, you delta hedge, and the market goes down 20%, 1% per day with 0%. I mean, the realized volatility of a straight line is 0. So ultimately, you bought a put, you delta hedge, and you lost money. Why? Because you bought implied vol at 25, you realized 0, right? So trading volatility as a Black-Scholes, which is the way market makers do, effectively, it's path dependent, it's an implied versus realized vol, and it's a mean reverting game. And it's a great defender. You know, your long volatility, it can work, but it's, as I mentioned, there is potentially some basis risk. The other way to think about options is different. You run a Monte Carlo simulation, you run 100,000 paths, and the premium represents the expected payout of those paths. Now, ex ante, the beauty of maths is that the premium derived from Black-Scholes and Monte Carlo is identical because you're using the same inputs, you know, the forwards, the vols, the stuff, whatever. Ex ante, they look like the same thing. The difference is when you buy a put option on, you know, you think about Monte Carlo, you think about the premium, you think about the expected payout. In this case, it's not just volatility the driver. You could have, you know, backward dated forward curves. You could have many things that impact. And here, which is more the way we think about it, is you're risking 1 unit of premium to make X. So in the previous case, if I had bought my S&P put at 1% and the market's down 20%, I would have made 20 times my premium. Okay, so we are using options in a directional way, but your stop loss, your worst case scenario is the premium, and you're not necessarily looking at an implied realized vol game. Is not even path dependent, because all you care about is where you start, where you end. And so I think in insurance, the way we think about it is, let's give ourselves a budget. Okay, let's give ourselves roughly 20% of the NAV to buy options. It's a big number, but let's do it in a way that we're diversified across maturities, across underlines, across payoffs. And then I don't really know what's going to happen. I don't know if oil is going to blow up, or China is going to blow up, or equity markets are going to blow up, or credit, or inflation, or gold, or the dollar. But if you basically accumulate insurance across this in a diversified manner, and we look for payouts that are roughly 10 to 1, chances are when crisis comes, something's going to happen somewhere, right? The degree to which they are expensive, which you pointed out, is not so much for me on the implied realized vol. Sometimes the risk premium comes in things like the skewness. So the market is, given the supply demand of insurance, means there's a huge amount of demand for a crash, right? So the market's not concerned about the next 5%, it's concerned about the next 30%. And so effectively what it means when you look at the options market is your distribution of prices is not log normal. You have this big hump that is coming through the skew. And what we try to do is say, okay, the market's giving me the money put quite cheap, is paying a lot for that. So let's flip the risk premium in our favor. And I'll give you an example. So a few weeks ago, now the VIX is lower, but with the VIX at 30, the 1 month $50 call was, guess what, 25 delta. And you scratch your head and say, how the hell? I mean, is the market's really giving a 25% probability that the VIX will go from 30 to 50 in a month? And clearly, if you think about historical cases, that probability would be grossly estimated. And that risk premium means the VIX might be high, the contango in the futures might be high, the volatility might be high, and the skew might be super high. So there are elements of risk premium, those imbalances in the market, that make insurance expensive in some cases. But if you actually buy the 30-50 call spread, you are in a way taking advantage of that negative risk premia, and you turn it into positive risk premia, because the 30-50 call spread, it's a 7-1 bet instead of what a normal market would give you, a 3 or 4-1. So ultimately, just like in the football match, being a goalkeeper is not easy. It's probably what the toughest job. A striker can miss 19, they score the 20th, and they're a hero. A goalkeeper can save 19 and miss one, and so I think goalkeeping is tough. Buying options is difficult. There are temptations to do funny things and buy an option and finance it by selling something else. These are recipes for blow up. I strongly recommend that people choose wisely on the insurance, but avoid.
Another question I have is around correlation. Because through a thread that kind of runs through everything is to understand that there's different players on the field who are distinctly different. So that presupposes that you know the difference between a defender and an attacker. They don't. You might think you have a defender, but it may actually be a striker. So, I mean, how do you think about correlation?
It's one of the most important things for risk management. In fact, I have a very visual slide I use in my presentations, where I look at the chronicle of a crisis foretold, kind of to paraphrase Garcia Marquez, right, and his book. Basically, you think about a scenario where we start with low volatility and low correlations, right? This might be a stable market, complacent market. There are three triggers here on the crisis. The first one is volatility goes up. As ceteris paribus, as volatility goes up, leaving correlations low or even negative, the value at risk, basically the volatility of the portfolio increases. But when you actually flip correlation, which is what happens in more severe crises. So phase one is volatility starts to go up, my value at risk goes up, I'm forced to liquidate, that creates some forced liquidation, deleveraging, margin calls, whatever. And effectively positioning of the market means that the correlations go to +1 or -1. The flipping correlation, it's a completely different order of magnitude to the VAR. And so effectively what you see is people have very complacent VARs. When the crisis hits and you get volatility going up, correlations polarizing, and liquidity drying out, effectively that triple whammy of vol, correlation, and liquidity means that the actual level of risk that you had in your portfolio is exponentially higher than what you thought you had. And this is the reason why we experience a lot of people with false diversification and hidden leverage, and it's the opposite of what you want. So I use that to show two things. First of all, be careful of not falling into false diversification, and second, let's accumulate things that behave exactly the opposite way. So think about gold versus euro. Okay, the market thinks that gold and euro are exactly the same thing. Gold is a bit more volatile, they move together. The probability that gold rallies aggressively and the euro collapses based on those implied volatility correlation is zero. So effectively, when those things happen, they always happen at the same time. You have the vol, the correlation, etc. So because we buy things on an implied basis, you're effectively buying that tail event, and you're creating payoffs that will be extraordinarily asymmetric in those scenarios. You can construct that, and we do it like put options contingent on dollar higher, gold higher, Chinese yuan lower. There's all sorts of combinations that use correlation that hopefully you accumulate during periods when it's artificially low, and you can monetize when these crises happen. But I do think correlation is hugely
it sounds
important.
Interesting. So you have a good sense of making sure that you have the defense, covered adequately through using options. You but you also trade correlation as well. So you take advantage of when implied correlation or the correlation that the market's pricing is
in log option format.
In log option format, correct? Yeah. So you kind of use that as an asset almost as well. Yeah. So it's quite a sophisticated approach, which I assume gives you an edge over other investors. I imagine, one would hope.
Well, look, yeah, I always say, look, this iPhone, right? Simple or complex? It's simple because my mom can use it, but it's now go and build it, right? So in some sense, I think the what's very important when you run these complex derivatives is that the risk is controlled, and the best way possible to control the risk is by just buying options, because if you spend $1 million in premium with 100% certainty, you can only lose 1 million. And that's why I sometimes when we look at the risk, people talk about VAR 95, VAR 99. I use VAR 100. I say, look, with 100% certainty, I cannot lose more than this. That in itself, it's restrictive because we're not selling options. We're not doing funky stuff that could distort that picture. But at the same time, it allows us to do effectively much more complex stuff only because we know with 100% certainty what the
downside is. Correct.
And you are creating asymmetry by construction. Yeah. This is, as you well know, investing is a game of asymmetry.
Yeah.
It's a symmetry of knowledge, of information, of conviction, of positioning. But ultimately, it's very difficult to calibrate. I mean, I know your work, and you've done amazing things in multiple of these, positionings and flows and M&A and whatever. But ultimately, calibrating those things is difficult. But calibrating the payout of a digital option where you spend 10 cents and the outcome is 0 or 1, a calibration is done perfectly. So and
it's better to use options and know that the premium is your downside than have a cash position and have a stop. So basically, I could buy the S&P. And then I could say, look, I've got to stop at say 3,800, and so I think my downside, assuming let's say the S&P is 4,000, I could then say, okay, my downside is 5%. In my mind, I think I know my downside is 5%, but in reality, I assume if we're dropping, I might not get the liquidity to be able to execute. To be able to stop out at that level.
Several risks. The first one is called gap risk. Think about the people that were long Euro Swiss with a stop loss is the infamous peg that broke on the 15th of March 2015, right? And people, the break was at 120. And apparently some people had stops at 119.75. And good luck getting out at 119.75. The market gapped 20%, next 30%, 40%. So the problem with the stop loss is that you're not certain or where you're going to get out. And people that have not been in the markets, they think that the market is this kind of black box where things happen. No, when you sell, there's somebody there with a bid buying, right? So these people with the bid might disappear or might be trying to sell as well. So the first thing is you have slippage, which could go against you. So you budgeted 5% and actually cost you 7%. But the second big consideration is there's probably nothing that pisses me off more, if I may use French, that to be correct and be taken out by the market. So you were convinced that the S&P is going to end up the year at 3,400. We sell it here at 4,000. You put a 5% stop, and we have a blip that takes us to 4,200. You're out, and the market gaps lower. So that's really, really painful, not only financially, but much more emotionally. And we can talk about emotions later because it's hugely important to stay in control. So the stops at me, in my particular case, I can't sleep at night. I can sleep perfectly at night with millions of dollars of premium and negative theta because I know that I have 6 months to be correct. But I cannot stand that the market will take me out in a week and then I'll be correct in 6 months because by then my budget is gone. And the third thing that I think it's important when you buy the option is your long volatility. So what is interesting is that financial markets, unlike other markets, effectively give you financial insurance the cheapest when you need it the most. Okay, so at 4,800 S&P, the VIX was at 15. Okay, so buying puts on the S&P at the top is cheapest because the market is like, oh my God, nothing's happening, the world is great. Well, that's the time when you want to buy insurance. And when the S&P is at 3,000 and the VIX is at 60, people are panicking buying insurance in case it goes to 2,000. Well, arguably, that's the time where you should be monetizing your insurance and buying the S&P. And so you have to be a contrarian in these markets. And implied volatility, it's one of those things that are highly negatively correlated to risk assets. And there are situations as recently where volatility in itself has not been a good defender because we've had a big sell-off without a big spike, arguably because we've just taken the froth of the market and other considerations. But I would say that for me, particularly, based on my mandate as a goalkeeper, based on the way my brain is wired and the way we look for opportunities, I am very comfortable buying options and doing that and understanding the risk premium and understanding the different aspects of risk premium, not only in the volatility itself, but also in the skewness and even correlation, and ultimately trying to find a portfolio that, again, across maturities, underlines, and payoffs, will allow you to capture and take profits and move on to the next insurance. So it's a full-time job, to be honest, to be a goalkeeper. And I don't think linear bets with stops on breaks is a good defender. And I would use another interesting case just to bring it back to the football. Yeah. CTAs. Okay, CTAs, which are trend followers, are funny, right? Because they were actually a great defender in 08, right? Because it was a long move. But if you think about it, and I know it's a stupid example, but what are we really telling? If the CTA was a football player, how do they play? And basically, we have a guy that we're saying, look, when we attack, I want you to be center forward. I want you to be at the top, scoring goals, max long. And then when they attack, I want you to run really fast and put the gloves and be my goalkeeper and do that all match long, right? Obviously, if you spend 45 minutes attacking and 45 minutes defending, then it works well. In a match where the market's up and down, you're going to get chopped to death. The guy's going to get red carded. Is going to be, so tired. And so you're always late. And I think CTAs in that sense, have a behavior. Are they the right defenders? How can you be the best defender if you're max long at the top of the market? Perhaps it'll be a good defender once certain things have happened and the trend has, and I'm overgeneralizing because there are obviously many different time horizons and triggers, but I'm just trying to keep things simple so people understand where does the diversification come from? Why would a CTA protect me? And certainly they will be very good in certain scenarios and terribly bad under others. So we have to look for the behavior of those defenders in ways that we hope will be as predictable as possible. But there are many, many considerations when it comes down to defending, capital preservation, carry, asymmetry, etc., which is what we try to specialize in and many people delegate.
Yeah. And the final question I wanted to ask, on markets was what's your view on crypto? I'm intrigued.
I am funny because I'm a very liberal guy. In my thinking, even in football, I'm actually an Atletico Madrid fan. My father played for them. I've been raised, but I also like Real Madrid. I am from Madrid. I've been abroad for many years, so I guess I'm quite misunderstood by both sides. The Atletico Madrid guys are hate me because I'm happy when Real Madrid won the champions, and vice versa. No, I'm a very liberal guy. I think Messi is amazing, Ronaldo is amazing. All these guys, and obviously with economics, I think printing doesn't get you, doesn't solve problems, etc. But I also think that crypto, I get asked all the time, and I wrote this piece which I haven't touched since I published in, I think it was January or February last year, so almost 18 months ago, called Bitcoin Bubble or Anti-Bubble, and it was a LinkedIn piece, quite lengthy, and the structure, it basically covers a few things. But ultimately, long story short, I think the complex is there's significant fallacies, and I'm personally, I think it's 80% bubble, 20% anti-bubble. I'll highlight a few, but the scarcity fallacy, right? The idea that there's only 21 million Bitcoins, right? Fair enough, but there are 21 million cryptos you can create out of thin air, right? So the counter argument to that, which I had with Daniel Lacalle, would be something along the lines of, yeah, but you also have, they're different, it's like comparing gold and silver. And I disagree with that as well, because when we wrote the energy book, basically one of the things we discussed is we all talk about oil, but nobody needs oil per se, right? We need clean, cheap, abundant, reliable transportation. So the fact that the market believes we need oil per se is not true. And in fact, the perceived success of OPEC and oil tends to be assigned to the oligopoly of supply, when in reality the success is a monopoly of demand. The only reason OPEC has been successful is because they had a monopoly over transportation demand, and that allowed them to do that. There are plenty of other oligopolies of supply which do not work. So ultimately what I'm trying to say is that Bitcoin is not special because it's Bitcoin, just like oil. It's serving a purpose, and there are infinite ways in which you could do that. And so this creates the civil war between the maximalists, those who believe there can only be one, as if it was almost a fanatic religious thing. And because the minute there's more than one, then it's game over. And so I understand why the Bitcoin maximalists want to crush everything else that is not Bitcoin, because they know the minute there's something else, it's game over. But this is just one of the fallacies. I encourage people. I start the article. I know that people get very emotional being called all sorts of great compliments, like from boomer to idiot to whatever. But look, it's nothing personal. I did the analysis.
But you also suggest 20% is anti-bubble, so you think there is something in there as well.
100%.
Yeah.
Look, at the end of the day, when you start analyzing this, there's some merit to this, right? So the first part of the argument, how many times I hear, oh, the Fed's printing so much money, inflation's coming, buy Bitcoin. It's like, I agree with the first two, but why are you jumping to that conclusion? We all know the fiat is bad. We all know they're printing. We all know we have an issue. We all know this, but that doesn't mean that this boyfriend is bad, therefore this one's good. No, dude, that boyfriend's bad. I don't know if this is a good boyfriend or not, or a girlfriend, right? So there are some arguments that are based purely on negative arguments. Okay, so concluding that something's good because something else is bad, it's a basic flaw in logic. Okay, and so many of those are based on that. The second thing is, if you think about the technology is a game changer. I'm not challenging that. I mean, I blockchain, these things are transformational. Okay, just like natural gas, fracking, and horizontal drilling, and etc. These are game changers, but it doesn't mean the fact that I was very bullish nat gas. It wasn't bullish nat gas prices. It was bullish nat gas and bearish oil. So you might be bullish in volume, but bearish in price. So the conclusion that the technology is good translates into into higher prices doesn't make sense. Many other arguments that have been used, such as network effects, right? And when I ask people, okay, define network effects, and they don't know, right? But they effectively, if I understand correctly, you have economies of supply. So bigger factories produce the marginal unit. This is the mirror image. It's sort of economies of demand. So as the demand for something grows, is more valuable. And they use the example of the fax, or the example of something that
like Facebook platform or something.
Yeah, exactly. The more users, the better. And the reality is, and it grows exponentially and whatever. And the utility of certain things might grow exponentially, but not necessarily the price. So, for example, if North Korea, which just hooked into the telephone network overnight, will have an exponential growth, it doesn't mean I'm willing to pay exponentially more for Telefonica or for my phone call, right? For anybody else. So I think ultimately, some of my best friends, are incredibly smart guys in technology. We have very interesting, polite, two ways. I am a huge believer in technology. I'm a huge believer in the transformative power of technology. I think there's a lot of credit which is in the anti-bubble side, but there are very Ponzi bubble things. Even decentralized finance, the whole DeFi paradigm. Dude, nobody wants regulated business per se. We regulate business for a reason. Okay, there's a history why finance is regulated. There's a history why electricity is regulated. Because if it's not, we have problems, right? And I think in some ways there'll be winners, there'll be losers, but ultimately I'm very skeptical. I've been very vocal about that, and I just tell people, look, my trading advice was, buy 2 units of Bitcoin, and when it doubles, sell 1, and you have a free Bitcoin. But don't lever up, don't sell your house, don't quit your job, don't do crazy things pretending that this is going to be like this forever, and it's going to be worth $1 million, because I don't think so. And I've seen this movie. You and I saw this movie in 2001. Yeah. I saw colleagues. Incredible people that were like, why do we bother being here? JP trading this if I can make more money with the .com. Some did, many didn't, and overall, I just urge for caution. I think, as I said as I start that piece, I said, I paraphrased Frida Kahlo. I said, I don't want you to think like me. I just want you to think. So here are the arguments, and you make your own decision. Based on these arguments, my conclusion is this: there is some merit, there's some optionality. I think Ray Dalio views it as an option, perpetual with whatever. But certainly, there are significant considerations and fallacies. So don't confuse technology or utility with prices. It's a very basic mistake, and do it in the right size without leverage and I think this brings me to emotional trading, right? I think the number one rule, in my opinion, is you need to trade with emotional indifference. If you're trading too big, you're going to be overly happy and overly sad. This is going to impact you. And I have a feeling from the kind of passion that goes around some of the crypto space that the size that some people might be trading is deep into the emotional tag, and that's dangerous, because you're gonna double up, extend the leverage, overtrade, and this is a recipe for bankruptcy, unfortunately.
Yeah, no. Wise words there. Well, actually, I did have some personal questions to ask you as well, now that we've talked a lot about markets. And one actually touches on that, which is, what's the best investment advice that you've ever received from anyone?
Best investment advice? I think the best investment advice comes from probably differentiating between decision and outcome. You can focus on making the right decision and not the outcome, right? And I would argue that if you make the right decision, you should expect the right outcome. If you make the bad decision, you should expect a bad outcome. But there are a couple of tricky scenarios, particularly bad decision, good outcome, which is playing Russian roulette and surviving. It's definitely a wrong decision and a good outcome, and vice versa. You took the right decision with the wrong outcome, which happens a lot. And so I think that's we have a lot to learn from sports and other areas. I think poker is a great game where you need to focus on the process. And so I think it's way too many people focus on the outcome, if a trade made money or lost money, instead of focusing on what is the right trade and the process. And I think that reflection on the discipline and the process, where it's a repeatable game where you have some edge, I think it's critical. And forcing yourself to think in probabilities and in decisions versus outcome. Personally, I think it's super important for both the upside and the downside.
That's great advice there. Another question I had for you was, there's many younger people listening to this podcast, many students who are just graduating and leaving university. What advice would you give to people leaving university as they enter the work world?
Well, probably the first one I would say is be long-term greedy, in the sense that you're going to be faced with, hopefully, with multiple job offers. If you are in my case, when I started, I had 50 rejections before it was just a very dire time. Literally a terrible time to start, but I think it's very important. The first job is super important because it's going to mark over time. I think it'll be more important than your degree, and as a result, I think the first job is super important. So take your time. I think the money that you earn in your first job is potentially a trap. So I would much rather work for the right firm and the right people for less money than the other way around. And I know that some people are trying to optimize their income since day one. And I'm not going to give the exact names, but when I left JP, I had the opportunity to go to Goldman, and there was another opportunity, a bank that was paying almost twice, which at the time was a ginormous amount in terms of, for me, of a lower base, right? And that other bank doesn't exist anymore. and I was long-term greedy. I was smart enough to know that it was much better to work for Goldman for less money than because my own mark-to-market, my own experience, my own potential was long-term positive, rather than focusing on short-term decisions that were based on monetary. So I think the critical thing is take your time. It's a super important job. Try to work for the best possible firm and people, because there's a lot of best practice, and they're going to influence your career and the way you think and view the world. And certainly money should be secondary, if not tertiary, in your first job, because £2,000, £3,000, £5,000 a year sounds like a lot of money in your first job. Hopefully will be negligible 10, 20 years down the line.
Yes, great advice there. Another question was, do you have a system or some kind of productivity plan on dealing with your day and dealing with information overload? I mean, you follow lots of markets, you write books, you do this, you do that. Is there some method to the madness?
Yes, it is, and it's the 80-20 rule. The 80-20 rule states that 20% of what you eat is responsible for 80% of your fattening. 20% of your clients are 20% of your P&L. 20% of your loss, 20% of your losses are 80% of your. So 20% of the cases of the actual trades that go badly are 80% of your losses. The 80-20 rule is actually Pareto. It applies. And my application is I am obsessed with cutting the 80% of crap from my life. So if you are able to, and some of my teams just almost joke about this. So when something comes in, they come to me and say, 20 or 80, like this thing just came in, an email or whatever, or something we need to do. It's really, once you understand what the 20% is, that's all you do. And I think in order to be able to be very efficient, you have to get rid of the 80%. 80% of people, 80% of clients, 80% of time wasters, and your brain's probably spinning right now. Like, yeah, Diego, I can tell. There's a few people that are, or cases or things. So to be most effective, I think there's two levels of prioritization. The first one is you need to silo your activities, your world. You need to prioritize, and then you need to basically understand that 80-20 horizontally and vertically, because if you remove that 80% of your life, suddenly you have time to call your mom, to go to the gym, to sleep a bit better, to read that book, to spend more time with those clients, to have time for yourself. You have time to read. And if you think about those, whatever it is, those painful clients that are taking time, they're really taking time away from 20% stuff. And that 80% has a 20-80 in itself. So and same with the 20. So it's I guess a process of constant prioritization. So every morning I try to look at this is what's ahead, and there are days where as a Navy SEAL I'd say today I'm just doing two things. This is the two things I need to get done today that will truly move the needle. But that's part of a very well structured plan that you know where you're going, and therefore you know what's in the 20, what's the 80, what you need and what doesn't. And I think that this is not a game of hours, it's a game of results. And we have a lot of demands, work, family, fitness, life, whatever. And so I think my hack would be just get rid of the 80% of crap in your life and you'll be a lot happier.
That's great advice. I'm very sympathetic to that. And you did mention reading books. I mean, you're an author yourself as well. I mean, are there any books that have really influenced you over your career or even in your personal life as well, even?
Of course. No, I think the first one is not, there's many, but the first one that influenced me a lot, it's more like a course, and where I did my thesis in real options. This really changed the way I saw the world. And I wouldn't pinpoint just to one book on the option side, but certainly the concept of real option as a way to think about the world. A book is an option. You spend you spend 10 pounds. You have the right, but not the obligation to read it. You spend you exercise that option, and some of them are worthless, and some of them, in my case, are worth tens of thousands of dollars, right, or more. So I think options as a concept is extraordinarily valuable. Relationship, everything's an option, like as far as I see it. Relationships, friendships, this discussion's an option. Who knows where it's going to take us, right? Yeah. But in that sense, one book that really marked me, and I'm a big fan of all three big schools. Warren Buffett, I think it's fantastic, and there's a lot done on the value world. I'm a big fan of Soros and his work as a trader. But I would recommend Taleb as more of the actuarian type of guy. So Fooled by Randomness. I think it's an incredible book alongside The Black Swan, and that really opens your mind to thinking about probabilities in a slightly different way. And we talked earlier about emotions. When I was a portfolio manager in one of these huge hedge funds, it's a bit like being a professional tennis player, right? You're 30, 40, second serve, fifth set, 5 hours of match, and you double fault, right? or not. And that's kind of the pressure that we might be under, right? You are underwater, tired, busy, big market, big client pressure, everything. So the mental aspects of the game are very important, and I tried to improve, to learn. I couldn't find really any good books on the trading side, but I found a fantastic book on the poker world called Poker Mindset, and I read that book in pretty much every line where it said fold, it meant stop loss, where it said this, and introduced some concepts. The idea of the mental aspects of poker are so important that I think there are lessons to be learned for markets. And it takes me back to this idea of good idea bad outcome. I think in poker they have the concept of tilt, which means once you go into tilt, once you start making suboptimal decisions, the only right answer is stop playing. There's nobody, and so in that sense, I really love this idea of cross education. So how philosophy, psychology, different fields of the world can be applied to others. I'm fascinated by that. I use all these analogies and examples of physics and sports and whatever, because it's effectively a multidimensional exercise where you can learn a lot. And so I encourage people to read books about many, many disciplines. But this is a good example. I think, the optionality, the idea of maths and randomness, the idea of emotions. But
that's great.
Yeah, I think I would finish with, a well-known saying, which is, if you have many ideas, write. If you don't have many ideas, read. But they both go together.
Yeah. And you mentioned tennis just as a side point. We're going off at a tangent here, but obviously Nadal is doing incredibly well at this sort of late stage of his career. He's won most Grand Slams out of the big three, Djokovic and Federer. There is an up-and-comer, Alcaraz. Is he the next big thing, do you think? I mean, we've had all these pretenders to the big three, and no one seems to quite make it. But is Alcaraz the guy?
He's incredible. I saw him. I was lucky enough to see him in Madrid during the Open, and it's truly exceptional. And both his shots, his physical strength, his mental maturity, it's truly extraordinary. It's still early. Good news is he comes from a family of his father was a tennis player. Juan Carlos Ferrero is great. I do think he has a lot of the ingredients, and he's already at such a young age competing with such strong guys and beating them in tight matches and whatever. Injuries could be an issue or whatever. It's very clear that he's going to be, if on this pace, he's going to be extraordinary. And repeating or replicating what Nadal and Djokovic and Federer have done is extremely difficult. He's a good candidate. He's playing very well across all surfaces. So, but obviously it's a function of the other players as well, which are amazing. And no, we're very, very, very excited. At a personal level, I'm a huge fan of all these guys. I have the biggest.
It's quite impressive that Spain keeps creating these great players. I mean, it's Spain.
I have no idea. No, we are. I would argue it's not quite a coincidence. I think it happens. Sometimes you get Schumacher, right? Schumacher out, and then suddenly I don't follow F1 as closely, but this fantastic driver from Germany lives like 10 minutes from his village. Is that a coincidence, or do these superheroes basically inspire people? You have more means, there's more following in the country, and so it's one of those things where perhaps Mexico has these unbelievable boxers, right? Or Philippines will do. Are they particularly, it's a chicken egg, right?
Yeah.
So I think Spain, we've been blessed with some incredible sportsmen which are inspiring others. And in the case of Nadal, he's doing an academy. They're putting the resources, and I think there is a good foundation. But it's a good climate. Many of the Russian players, Kachanov, Rublev, they've actually raised in Spain, speak perfect Spanish.
Okay.
It just happens to be a good climate for Andy Murray. Many of these guys have spent a lot of time in Spain, so it's a little bit easier to play tennis in Spain maybe than Scotland, I would argue. But other than that, there's a lot of passion. We've been very blessed and lucky. But unbelievable respect for Djokovic and Federer and all the guys, Zverev, and so for tennis lovers like myself and many of us listening today, it's fantastic to see these guys coming, staying, and the other guys coming. So I was heartbroken when I saw Nadal play Alcaraz. I have identical twin boys, by the way.
Okay.
And they play quite a bit of tennis, and a couple of times they played each other in the final, and
it's hard.
Heartbroken because I was like changing sides. So I feel the same with Rafa and Alcaraz. I love both, and I wish both could win. But anyway, we'll see how long we're blessed with them. And
I live in Wimbledon, by the way, so I'm kind of tennis central here. And so, it's great. Great to see the new generation come through.
Wonderful part of the world. Beautiful.
Yeah. Okay, and the final thing, of course, is if somebody wanted to follow you, your thinking, your work, I mean, what's the best way for them to follow you or contact you or connect with you?
Well, easy. I guess Twitter, Parrilla at Parrilla Diego, RRL. I'm also in LinkedIn. If you follow me on Twitter, you can also follow the newsletter. It's called the Anti-Bubble Report. I don't publish too much. I tend to, react. To be honest, I enjoy reading this stuff, and suddenly I hear stuff that surprises me positively or negatively, or makes me think, and so I will react. If anybody's interested in our strategies or ideas, then they can DM me, and we can have a direct discussion.
Yeah. But I'll include links on the show notes as well, so people can just click through everything to make it easier. Yeah. Well, so with that, thanks a lot for this very informative and entertaining conversation, and good luck with everything.
It's been my absolute pleasure, and congratulations on the great work. And it's been an absolute pleasure to catch up again. My best of luck to everybody. Great. Much health. Thank you. Bye-bye.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.